In this week's SoFi breakdown, we're still talking about why the Santa rally ghosted us, why the reindeer apparently refused to pull the market higher, and what kind of drama might be setting up next for our favorite chaos fintech. Welcome back to Fintech Spy, where we don't just trade the volatility. We zoom in on it, overanalyze it, draw three different fib levels, argue with ourselves about risk management, and then make fun of the whole thing. If you're new here, hit that subscribe button for more chaotic fintech breakdowns, terrible market analogies, and occasionally accurate memes. Let's hop right into SoFi. Quick reminder, I am not a financial advisor. This is not financial advice. If you're making real trades based on a parody segment, you probably shouldn't be trading. This show exists purely for entertainment, education, and the shared coping mechanism of watching candlesticks together while pretending we're emotionally stable. Let's start with the weekly chart, our medium-term view. On the weekly chart, we technically have a red candle, but it's the most alive red candle we've seen since early November. This isn't the lifeless bleed out we had before. It actually looks like buyers and sellers are arguing again instead of unanimously agreeing that gravity wins. Midweek, volume is already around 237.9 million shares, which is a lot of paper changing hands. That kind of participation usually means the market is actually paying attention, not just slowly walking away from the ticker. We're still sitting in oversold territory on the higher time frame, which keeps the door open for an end-of-week rally if buyers decide they've had enough pain. It doesn't promise a face-ripping squeeze, but it does upgrade the weekly story from just fall to maybe we're building a launch pad out of emotional damage. Zooming into the daily chart, our short-term view. On the daily chart, SoFi has been doing its best impression of a construction crew, filling old gaps and accidentally opening new ones. First, we finally came back on Monday to fill the gap from December 4th to 5th, the one that showed up after the stock offering drama. In classic SoFi fashion, that gap fill celebration immediately created a fresh little gap the other way. The good news is that the very next day, profit-taking and a clean sell-off came in and closed that new gap too. For once, the chart actually finished what it started instead of leaving another open wound in the price history. Momentum-wise, stock RSI and MACD both have room to breathe higher. We're not pinned at the top. There's still space for a short-term rally without instantly hitting overbought territory. Short-term, that sets up a likely mix of sideways trading into Thursday, with the potential for a spike back toward the 28 area if buyers decide to flex into the end of the week. Now let's shrink things down to the 4-hour chart, where intraday drama lives. On the 4-hour view, that gap fill and profit-taking sequence looks even louder. We had that sharp move up to close the old gap, then an almost petty little sell-off that flushed out late chasers and cleaned up the new gap on the way back down. Since then, price has started to stabilize instead of behaving like a falling piano. Candles are getting a little tighter, the swings are getting a little less ridiculous, and intraday volume is starting to look more like normal trading than a panic carousel. It's not exactly calm, but it's more like the market took a deep breath and said, okay, let's see who actually wants to hold this thing. From a pattern standpoint, this is what you want to see after a flush. Less chaos, more structure, and price attempting to build a base instead of digging a deeper hole. Think of this as the construction crew patching potholes on the intraday road so the next rally doesn't immediately blow out a tire. Let's talk options, because that's where the emotional damage gets a price tag. On the January 9th options chain, you can see a classic tug-of-war setting up. On the put side, there's meaningful open interest stacked around the $25 and $26 strikes, traders trying to draw a line in the sand for downside protection. On the call side, the real focus is higher up. The 27, 28, and especially $30 strikes are where the optimists, degenerates, or visionaries, depending on your bias, are planting their flags. 30 in particular looks like the crowd favorite, the level people keep circling as the just one decent rally away, fantasy target. Put it together, and you get a chain that's split between please don't break support and send it back toward 30 so I can feel something again. Most of these contracts will quietly expire and donate premium to the market makers, but while they're alive, they tell you exactly where traders' hopes and fears are parked. So what's the outlook from here? Big picture, this whole sequence feels less like a clean new trend and more like a messy reboot. We've got gap fills, profit-taking, stabilization attempts, and an options chain that's basically a therapy session for everyone stuck between $25 support and $30 hopium. If buyers keep showing up and volume stays real, this has room to turn into a proper character development arc instead of just another plot twist in the emotional damage saga. If they don't, we're right back to asking why our favorite fintech name insists on speedrunning every stage of grief in 1 week. As always, this is entertainment, not advice. If you've got your own read on SoFi's next move, or you're just here to cope through sarcasm, drop it in the comments. And if there's another ticker you want roasted under the Fintech spy microscope, throw that down below too. We can't promise returns, but we can promise absolutely over-the-top analysis.